What is up, guys? Good morning, good afternoon, and good evening to you. My name is Kenny, and today I'll be talking to you about fundamental analysis about a company called ARA Assets Management Limited. I know this will be very dry, but I'll try to make it fun for you. First off, let's talk about the company itself. This company is actually based in the sector of financial, and the industry they are in is actually assets management, whereby sub is actually, private equities and capital markets. And look at this logo. The things they usually do on, let's say, what kind of sales, what kind of business they usually do is based on REITs itself. And they manages a lot of private real estate funds, management services. Then they also offers corporate finance advisory services. Moving on, you can actually see that, like I said, they do a lot of REITs and they have other, management, but most of the time, right, they're doing REITs, and most of their sales comes from Singapore itself. There's other countries like China, Malaysia, Hong Kong, but most is from Singapore. And what is fundamental analysis? It's actually a method of evaluating securities and investment, but in other words, it's actually to determine the true value of a company or a stock. And first off, fundamental analysis, there will be three parts that I'll be talking about: company, economic, and industry analysis. Whereby based on these 3 points, I'll be talking about quantitative analysis and qualitative analysis, which I'll talk about later. As for quantitative, it's actually numerical data analysis, whereby I'll be talking to you more about ratios, valuation ratios, profitability ratios, leverage coverage ratio. All of these ratios I'll be talking to you later, so stay tuned. Coming up will be qualitative analysis. Like it says, it's totally the opposite of quanti, which is non-numerical data analysis, which includes management, what they do. Whoa, my voice just cracked. And let's begin. Company analysis, I'll talk about the quanti first. Valuation ratio, PE ratio, price earning. It actually shows the market price of a share to the company's earning. It indicates the stock's value, and usually high PE ratio usually means that investors are willing to pay more to buy the shares of those companies which they think have good prospects. And let's take a closer look. ARA actually does quite well, and I see that they are doing way above the average, the mean. Not really way above, but they are doing quite good. But the problem is the trend is going down based on 2010 to 2013. Although the trend is going down, they seems to be doing still a little higher than average. So I would say this is a so-so situation. And moving on, profitability ratios, net profit margin. This actually shows the percentage of each sales dollar earned as net profit. And let's take a closer look. Normally, let's see, the higher the profit rate margin, the more sales dollars are providing profits to the business, and hence, the lesser net sales dollar are absorbed as expenses. So a ratio of at least, let's see, 2013, 65.1% will mean for every $1 net sales generates like 65 cents of net operating profit. I think it's rather good. And you see the trend, it dropped, then it rise again. Okay, basically you see, like the same as before previously, they're doing better than an average, and yeah, I actually think this is a very good thing. And okay, let's see, take a look at the market capitalization. Normally, when it's low, like this one, 1,000 million, okay, 1 billion, it actually means that it's quite risky, and it also means that there are higher returns. For those who want to have like lesser returns but more safe, right, they actually can go for higher market capitalization. My tongue is not working. Okay. Return on assets, it actually measures the company's success in using its assets to earn profit. Let's take a closer look on the ROA itself. It measures the success, yeah, I said that really right, in a ratio of 23.3% will actually mean that for every $1 assets generated a profit of 23 cents, which is good. I mean, like, look at this. Although it has dropped in trend, but it's still doing way above the benchmark or how the peers are doing. Like you see, this is the highest 23.3 against 5.7, 2.3, 10, 7.9. It's like the outlier, but still it's doing very well, although it's dropping over trend. Return on equity. This shows the relationship between net profit and shareholders' investment in the company. A closer look to this would be like, it actually measures the return of ordinary shareholders receive on their investment. A ratio of 28.5% based on 2013's data would mean that for every $1 invested by the ordinary shareholder, they earn a net profit of 28 cents, which, like the previous case, is still doing way above their peers, the average, but still is dropping in trend. But no worries, I still think this is a good prospect. Last but not least, EPS, earnings per share. It actually shows the amount of net income per share of the company's ordinary share issued. And taking a closer look, it measures the net profit attributable to one ordinary share. It has a clear trend of it has a clear rising trend from 2007 to 2013. Even expected of 2014 and 15 is still in a rise. I would say this is a very good thing. Normally people would prefer a higher EPS. Alright, to leverage and coverage ratio, I'll be talking about current and quick ratio. This actually measures the ability of the company to pay their CL, the current liabilities, with their current assets. Whereby quick ratio is actually a better measurement of liquidity compared to current ratio. And let's see, normally a high ratio for these two ratios is better, but from this graph you can actually see that it's dropping. Like, even though it's dropping and it's quite low, the ratio, but it's still quite healthy. I think it's like for every $1 owed by the firm or the company, it has $1.80 of current assets to convert into cash to meet those debt obligations. It's still okay, but the problem is it's dropping in trend. So what does it say? Normally, a higher current ratio will be more desirable, and this indicates the firm's ability to pay its debt at a very short notice. To me, this is actually so-so situation also. But coming up to this is more important. AR ratio, it measures the company's ability to collect cash from credit customers, and this shows a very obvious trend of drop. And to me, I feel that this is a bad case because it shows that the company is, having a low debtor turnover, which indicates that cash is tied up in debtors, and this will actually mean that there will be higher risk of bad debts. So I would say this is a bad point. And looking at the graph of this, you can see that this company is doing way better than the STI index and peers, and this volume which shows how good it is. And I've taken some graph of the recommendations from other people. Most of them are saying to buy. So those beginners like us, they actually want to invest in stocks. You can actually look at all these kind of brokers, their recommendations, and follow them. That's what most of the beginners do. And the business strategy actually is quite organized and effective, I think. Like, because they're managing a lot of REITs, they want to make it even better and sell out more products for their customers, and also to even expand their business to geographically, like to other countries, to make itself even bigger. And looking at their structure charts, I think their management is rather good, because I have looked through their reports and looked through how are their backgrounds like. I think this is a rather good structure for the company. And like all the saying goes, if you want to fight a war, you must have a good general, you must have a good brain, right? Don't you think so? And with all these people, this management on top, it actually creates a good corporate governance in their company, which I think is a very good point. And looking in the industry analysis part, they're actually doing very well for the industry, because you can see the assets under management is actually rising. And the reason for this is actually because the assets managers are contributing to this growth mainly by launching a lot of new innovative products. And I actually cropped out this news from Straits Times. It actually indicates that the industry is having a very good growth now, and it's not bad. This graph actually shows how well REITs are doing, which complements to the company. And most of the funds, most of the investments are in the Asia Pacific, whereby I think you'll go to Singapore mainly because Singapore is like a big financial hub. No matter how good the industry is, there will be some setbacks. However, you see, this company is doing in this industry with a very low market share of 1.43, and this actually means that there's a lot of strong competitors in this industry, which means that the barriers of entry isn't that high or low, it's quite in the medium. That's why people are able to enter if they are strong enough. This should mean that this company is actually in a very competitive industry. And looking at the economic analysis, Singapore has grown a lot and has become a financial center to not only Singapore itself or the Asia Pacific, or it actually is grown to the world. And Singapore is highly regarded by the key financial institutions and players as ideal place to come in. And just looking at a few Singapore economic indicators, Singapore GDP is on a rise and is expected to continue. Even the inflation rate is doing very well, it's dropping. And not only that, Singapore is actually very pro-business environment, and what do I say? This is very good for asset managers to come and expand their business in Singapore or Asia, because the country is very attractive for business. And looking at their regulations, right, Singapore's legal and regulatory framework has been ranked second in the world and is recognized for maintaining, the most protective IPR regime in Asia. In summary, Singapore is just a very good regulatory framework because it remains very transparent, robust, and well communicated to a lot of people, to a lot of industry, to a lot of places. The infrastructure is good. Everything is done here. We have nice office, we have nice places, everything is nice, and there's a lot of well-trained workforce. A lot of people here is very sophisticated in their products. They know whatever they're doing, and it's also very diversified and equal. Singapore is a very vibrant and cosmopolitan city with ample opportunities for all, regardless of race, language, or religion. And what I would say is Singapore is actually a very attractive place for investments to come in. So country-wise, I wouldn't be so worried. I would worry more about the industry itself, because with a lot of competitors around, actually in the long run, it might get a little tough for this company to work in. But nonetheless, based on whatever I've said just now about the company analysis, the economy analysis, and the industry analysis, I would say we should invest. Although there are some bad points and good points, but still looking at a longer trend, let's take for example a bonus. I have this technical analysis here. I show up this company is actually doing above average from the STI index, and based on the indicators like MACD, RSI, Bollinger Bands and stuff, I actually can conclude that this company is actually doing pretty well in terms of technical analysis. And I would suggest or recommend going into this or invest into this stock or company, as I believe this will, have a good prospect. But the problem is, if you want to gain in the long run, I would prefer you to hold, because in a short run, you might get a little tough, because I can, based on the smaller graph, actually see that it's quite dropping. But no worries, if you want to hold long, you'll have success in creating profits. And you know what? After all I said, thanks for watching. My name is Kenny, and I hope you enjoy my little fundamental analysis of ARA Assets Management. Thank you.